guys, just coming to you during this highly volatile and highly uncertain market. There's a lot of pessimism that is out there. Some of the data we are studying shows us that pessimism is almost at historical highs. So we know that there's a lot of fear, there's a lot of uncertainty that you are thinking about in today's financial markets. But the point of this video is basically to put this volatility into perspective. What are some of the lessons that we can learn from by looking historically at previous times when the S&P was highly volatile? Periods like, for example, Russia invasion of Ukraine, the outbreak of the COVID pandemic in 2020, or when the Federal Reserve was raising interest rates very aggressively in 2022. So what are some of the historical lessons that we can take in this highly volatile environment? I know at the time when you guys are going through this, when you're seeing it all the time in the financial media, this might feel like the worst time in the world. But we have been through similar very volatile times, and what has happened is we have come out on top. Okay, so one thing that we want to convey through this video is please do not lose your head. We'll provide you with some historical lessons that are there to remind us that it is important to stay invested for the long term. The second point of this video is basically to provide some of the strategies that we are currently now doing for our clients and some of the strategies that you are able to do also for your own portfolio. Okay, markets are down right now from the all-time highs, and it is not a time to do nothing. Okay, this is actually a time when you should, and this is a time when we are actually very, very busy because this time is not going to last forever. As we are going to show, financial markets go down far less often than they actually move up. So time is of the essence. What are some of the things that you can actively do today that are going to give you a lot of benefits in the future? Okay, so let me start off at the top. Markets right now are off from the all-time highs. In a textbook world, corrections defined as a time period when the S&P is down 10% from its all-time high. Looking back historically until about 1928, these are not very rare events. In fact, they actually happen about once every single year. Bear markets, defined as the time when the S&P 500 is down 20% or more from its all-time high. These are less rare events. They happen actually only about once every 3 years. So far, we have not technically hit a bear market. The S&P was down about 19% from its all-time high. So technically, we are not yet in a bear market, but it is one of the things that we wanted to convey is that these type of events, these type of drawdowns, especially 10% drawdowns, happen relatively frequently. Okay, at the time, it might feel like the worst thing in the world, but they happen with regular occurrence. Okay, so it's once again to stress, please do not lose your head because we have been in similar environments before. The second thing that we can learn from historical data is that bull markets last significantly longer than bear markets. In fact, looking back at the data to the 1960s, bull markets last about 5 years. Okay, bear markets last about 14 months. Okay, so a little over 1 year. Okay, so when stocks are falling. So bull markets are significantly longer than bear markets, and that is why it is important that some of the strategies that we are going to be talking about later on in the video, they are going to be implemented as soon as possible. As you can see in this diagram that we have shown, the bull markets are shown by the blue rectangles. They are much longer in length and much bigger in height as compared to the bear markets, which are much shorter in length and lower in height. Okay, so that's the second lesson to learn, that most of the time, in fact, about 80% of the time, stock prices tend to go up. The third lesson is timing the market is more important than timing the market. A lot of investors nowadays say, well, I'm not going to invest. I'm going to wait till the market bottoms out, till when things become more clear. That's when I'm going to invest in the financial markets. No one is smart enough to predict the bottom, not even Warren Buffett, because you are trying to predict something that is unpredictable. Okay, stock markets are by definition unpredictable. If everybody knew where the bottom was, well, we would all be millionaires. And in fact, the best days are often followed by the worst days. This was very, very evident in recent times when Trump announced the reciprocal tariffs pretty much on all of our trading partners. We saw one of the worst sell-offs in the financial markets that we did in recent history. Only subsequently to revert course and say that those reciprocal tariffs are now going to be delayed by 90 days. And what in fact happened was we had one of the best days in the financial markets in recent history. And data shows that if you miss one of those best days, your returns and the overall value of your portfolio is significantly less than somebody who was invested during the entire time period. Okay? So the third lesson to learn is do not try and be smart. Do not try and think, well, I'm smarter than the market. I know when the bottom is going to come in, because most likely what is going to happen, you're going to miss out on some of the best days in the financial market. And that is going to have a massive impact on your ending balance. So probably something that you are now very interested in is what we are doing. What are some of the strategies that we are implicating for our clients to take advantage of these drawdowns? The first thing is we are putting excess cash to work. Okay, so some of our clients are sitting on a higher cash balance. And what has happened now is some of the companies that we love a lot, they are down 20, 30, 40, some of them 50% from all-time highs that we saw back in January. Okay, so we are using this excess cash in order to purchase those companies at a significant discount. You might ask, well, what happens if I don't have cash on the side? What happens if I'm fully invested and I don't have access to any more cash? Then what you would have to do, and as I say, we are doing this actively for our clients, is to rebalance your portfolio. Okay, if a portfolio is well designed, you are going to have some things in the portfolio that are going down, like right now we have public equities decreasing, but other things in the portfolio should be increasing in value. For example, things like treasuries or things like commodities, especially gold prices this year are up a lot. So what we mean by rebalancing is now that stocks have gone down in value, selling those assets which have appreciated and buying those assets which have gone down in price. Okay, so the first strategy is putting excess cash to work or rebalancing your portfolio. The second strategy is tax loss harvesting. Okay, tax loss harvesting is selling securities that have gone down in price, maybe 20, 30, 40, 50% in value, capturing that loss and using that loss to offset your income in order that you're going to pay lower taxes. By selling that security which has gone down in price, you are able to use those proceeds to purchase a security that is similar to the one that you have sold. A good example of that is, for example, Walgreens and CVS. A tax loss harvesting strategy here might be selling Walgreens, capturing that loss, using that loss to offset your income, and doing so paying lower taxes, and using those proceeds from the sale of Walgreens in order to purchase CVS, which is a very similar security. It is important that you contact a CPA or a qualified accountant, because there are some rules associated with tax loss harvesting, such as the wash sale rule. So it's important that you contact someone who's knowledgeable about this. But this is one strategy that we are actively doing for our clients today. And lastly, Roth conversions. Roth conversions is converting traditional IRAs and 401ks into Roths. Now, the reason for doing so is the distributions which are going to be taken out from a Roth are going to be taken out tax-free. Why would you want to do that right now? Well, one reason is security prices have fallen, so you'd much rather pay taxes now, put it into a Roth, which is going to, over the long term, grow, and those withdrawals are going to be taken out tax-free. Another reason, probably a longer term reason, is that we are in a deficit and probably tax rates are going to go up over time. So Roth conversions are valuable today, and they are especially even more valuable today because asset prices have gone down. Okay, so these are some of the 3 strategies that we are recommending doing for our clients. If you'd like to know more, if you'd like to contact us, please visit our website, advisormanageportfolios.com. We are here to help you, and we look forward to another video and educating you further.